Did you know that Warren Buffett is a master of investing? He's like that cool grandpa who knows more about money than anyone else. And what's even more impressive is that he's happy to share his knowledge with anyone who's willing to learn. In fact, he's even revealed the secrets to making millions with just a little bit of money. Believe it or not, you only need 3 stocks to reach Lamborghini status. You don't need a finance degree when Warren Buffett tells you what to do. He swears by value investing, which means finding undervalued stocks and holding onto them for years and even decades. And in this video, let's talk about how Warren Buffett is making millions with just 3 stocks. What's up, friends? Thanks for stopping by at Capitalista. Before we get started, please take a second to smash that like and subscribe buttons down below. The desire to become rich quickly is common, but those with patience are often rewarded even more. Being patient is important, but it's also essential to be persistent and avoid making rash decisions during a downturn in the stock market. There are signals of a recession right now, but some people still believe that a new bull market is coming. Warren Buffett has a lot to teach us about making millions by buying undervalued stocks. His investment philosophy involves holding onto stocks for years, even decades, instead of trying to time the market. This strategy is based on the power of compounding, which means that the longer you hold onto a stock from a high-quality company, the greater the returns will be. Warren's investment approach involves finding undervalued companies whose stock prices are lower than their intrinsic value. This is based on analyzing their financials, assets, and earning potential. By purchasing these undervalued stocks, he maximizes returns when the market eventually corrects itself and the company's true potential is realized. This approach requires extensive research and analysis rather than just blindly picking stocks. Warren also believes in holding a concentrated portfolio of stocks rather than diversifying across many companies and industries. He believes that diversification can actually reduce returns and lead to mediocre performance. He prefers to invest in companies that he believes in and trusts. This approach is not magic, but rather a sound strategy for those who understand how to analyze businesses. Diversification is only necessary to protect against ignorance, and those who know what they are doing can focus their investments on a handful of companies. Now, if you're good at analyzing and valuing businesses, owning a large number of stocks doesn't make sense. There aren't many wonderful businesses that one person can fully understand. It's not wise to invest in a less attractive business and forego the most attractive one. It shows that you don't really understand the businesses you own. The idea of owning many stocks for diversification purposes is not always helpful. Warren Buffett, for instance, owns only 1 stock, but he knows it very well. He doesn't need to own many stocks to diversify his portfolio. He could pick just 3 of the wonderful businesses he knows, and that would be enough to do well in life. If someone is looking to build wealth, it's not necessary to invest in 50 companies. Most fortunes were built by people who identified with a wonderful business like Coca-Cola. There aren't many companies like Coca-Cola, and you won't find 50 or even 20 of them. However, a great business is very well protected against the economy and competition. Investing in 3 of these businesses is safer than investing in 50 well-known big companies. It's incredible what has been taught in finance classes about diversification. If Buffett had to bet on his family's fortunes for the next 30 years, he would choose 3 businesses that he knows well. In addition, modern corporate finance courses don't impress Buffett. He thinks they're not that useful. However, he knows there are risks in investing, especially if you only hold a few stocks. If one of them loses a lot of value, it can greatly affect your overall returns. But for Buffett, the potential rewards of having a few high-quality stocks are worth it. For most investors who don't want to do a lot of research, Buffett suggests buying low-cost index funds that follow the S&P 500. This way you'll get average returns, but they're reliable. It's a pretty good return, around 7% a year, which is better than many crypto investors are getting now. Now let's talk about how Buffett made a lot of money by investing in just American Express, Coca-Cola, and Wells Fargo. In the 1960s, American Express had a big problem. They were involved in a scandal and their stock price dropped a lot. Many investors were scared and sold their shares, but not Buffett. He saw this as a chance to buy a great company at a low price. He believed in American Express and they knew they had loyal customers and a strong competitive advantage. He invested $1.3 billion in their stock and held onto it until 1995. Today, his investment is over $22.4 billion, 17 times more than he originally paid. Plus, he gets a 23% dividend rate. This is the power of value investing, which Buffett uses in all his investment decisions. The next company that Buffett invested in was Coca-Cola. He saw the potential in the brand when it was not as popular as it is today and invested a total of $1.3 billion in the company to get 6.2% ownership by 1994. Today, his stake in Coca-Cola is worth a whopping $24 billion. Wells Fargo was another company that Buffett invested in because it had a low price but was still a well-managed bank with a lot of potential. He started investing in the company in 1989 and his initial investment was $290 million for a 9.7% stake, which grew up to 13.3% until 1994. Buffett's investment in the company has been highly profitable through dividends and continuous increases in stock prices. However, due to corporate issues, controversies, and the lost moral compass of the company, Buffett cut ties with Wells Fargo in early 2022 and sold most of his stake. Buffett's investment philosophy focuses on long-term investments in high-quality companies with solid fundamentals. He looks for undervalued stocks with strong growth potential and holds a concentrated portfolio of his highest conviction picks. While this approach can be risky, it also provides the potential for significant returns. However, investors should conduct thorough research and analysis to ensure each holding is a high-quality company with strong fundamentals. Investing takes time, patience, and a lot of hard work. Investors should start by understanding the basics of investing and then learn how to read financial statements and research companies. Investing within their competence circle and setting long-term goals is essential. Buffett's investment philosophy has been widely studied and celebrated for its simplicity and effectiveness. While some investors may prefer to invest in a diversified portfolio like the S&P 500, others may focus on a few key stocks. Ultimately, deciding to invest in a concentrated or diversified portfolio depends on an individual's risk tolerance, personal circumstances, and investment goals. So do you think Warren Buffett's investment strategy would work for you? Let us know what you think in the comment section down below. And that's the end of the video. Don't forget to show some love by hitting the like button, subscribing to our channel, and turning on the notification bell. By doing so, you'll always be up to date and won't miss any of our new content. See you soon and stay safe.